Hi, I'm Grant Stevens.
And I'm Kris Bernier.
And we're the Two Investment Guys. This week, Kris and I want to return to talking a little bit about some of the market dynamics. We've seen markets improve over the last few weeks, and what we notice is that we're now in some of the major markets at the same levels we were in 2007, a year before the global credit crisis. So we have had some stability and some building blocks, Kris, put back into place. But we still wanted to touch on some of the major issues that are still at play. And why don't we start with what the U.S. Federal Reserve Bank is up to?
Sure. Well, on September the 13th, the long-anticipated announcement by the Federal Reserve that they were going to implement another round of what they call quantitative easing, essentially out buying assets, in this case mortgage-backed securities, in the open market and bonds to the tune of about $40 billion a month. The difference this time around is they haven't put a time frame on it. It's left as open-ended until such a time as there's some meaningful improvement in job growth in the U.S. So this could be going on for a while. The other thing that they did, Grant, was they said that rates are likely to remain low until at least 2015. So for Canadian consumers, it's likely that the Canadian rates will also remain at or near the current levels.
Right. And that's interesting, Kris, because they bumped that out another year. They were talking mid-2014, now they're talking mid-2015. If we turn to Europe, we've seen a couple of developments there with the ECB, and the primary one recently was the German constitutional or parliamentary vote regarding their stability fund over there that helps them with their bond buying. And really what all that means is the German parliament approved the plan, but put some limits on it, and that is it's about 190 billion euro would be the limited liability to the German taxpayer. What all that really means is they're taking steps in Europe to stabilize the bond market and the debt crisis, bring that to a little bit more of a manageable plan. And I think that's a positive, but the debt crisis still exists in the fact that it's just a tremendous amount of money.
That's right. So what we saw was an immediate reaction in the markets to the upside. We saw the US dollar weaken on that Federal Reserve announcement. Commodity prices strengthened pretty much across the board. And that's what we saw in past quantitative easing programs. The difference this time around, I think, is that we'd already seen a fairly good lift in some of those prices from some lows earlier in the year. So it'll be interesting to see where things go from here.
Right. Kris, in terms of connecting the dots, the interesting thing here is every time the Federal Reserve does something like this, essentially they print more money. And in order to print more money, one of the net outcomes of that is there's a lot more US dollars around, therefore the US dollar becomes a little bit diluted on the global stage, therefore it's worth a little bit less money, therefore gold turns around and goes up, and so does some of the other commodities. And so that's the give and take in all of this. We do see some positives, of course. The earnings front has stabilized. We're hoping to see some improvement in forecasts out the next couple of quarters, Kris, but really earnings have been good. And as well, there's some indication that the U.S. housing market has bottomed. So there are a couple of things that we're watching here that are a bit of a bright light.
Yeah, absolutely. The one risk, or I guess a couple of things to keep your eye on going forward, the U.S. election upcoming in November and the so-called fiscal cliff, which would be the expiration of the Bush tax cuts, and that would be about a $600 billion touch to the U.S. economy that would take a big bite out of GDP if that's not resolved.
Yeah. Kris, when we look at markets right now, good idea to have a look at the portfolio, just make sure you're on track with what you're comfortable with. We're still on the yield story about being paid to wait as we go through the bumpy times until things really improve somewhat.
That's right. Thanks again for your questions and comments. Please keep them coming. You can contact Grant and I at TwoInvestmentGuys.com.
Join us next time. We're going to continue talking about some of the dynamics in the market and how we see it playing out. So until then, I'm Grant.
And I'm Kris.
And we're the Two Investment Guys.